Joining me now at Post 9's Lauren Goodwin of New York Life Investments. Welcome back.
Thanks for having me.
How are you feeling about the markets here as this quarter begins?
I anticipate that on a 6-month basis, the equity market rally has room to run, risk assets have room to run. It's a constructive risk asset scenario. That said, the economy is really walking a tightrope, not teetering on the edge of recession or anything like that, but a real balance between overheating and the market being concerned about growth. And so in that environment, though I expect risk asset performance to be average, that might not feel as good for investors as the last couple of years. And so we're looking at portfolio construction really closely to try and take advantage of big picture themes like, for example, the Fed moving lower in interest rates.
Feels like, though, tightrope to me sounds a little extreme. I mean, connotation being that one wrong step and you fall over, where it feels like the road is a little bit smoother than many people thought it would be. Sure, there are potholes in front of us, but this has been really resilient, and we've been able to steer around most anything that's been thrown our way. How would you respond to that?
I think that's really fair from an economic perspective. And as you know, we were quite concerned about the economy in the first half of this year, moving much more constructive because of that resilience, and specifically the resilience in profit margins. And so the balance beam is less about teetering off into an abyss and more about how does the market absorb the reasonable economic data that we have. So, for example, a weaker than expected jobs report that's likely to be a concern for growth, potentially volatility in risk assets, maybe expectations that the Fed might cut a little faster, whereas even just a little smidge of data in the opposite direction gets you the exact opposite result. That's a challenging environment for anyone who's trying to invest for longer than a day. And so that's the tightrope that I see really more for risk asset performance.
But what if we just say, net, you've been using the word distill a lot lately, I have, because there's a lot out there, but some would distill it all down and say, Fed's cutting, economy's still good, and that's really, at the end of the day, those are the two most important things that matter more than anything else. We get that good news is good news and bad news is bad news. A bad jobs report would obviously be concerning, but net, cutting, still strong, that's what matters.
I tend to agree with that. And so if the economy is still strong or resilient, let's say, and the Fed's cutting, what do you do? I mean, the number one concern for investors then becomes reinvestment risk.
Wait, don't you buy equities?
I think that you buy risk assets, but I strongly prefer credit. And the reason is not that I think equities are going to do poorly in this environment, but that the upside relative to credit is limited. And that's because both assets have really performed quite well on a price or valuation level. And so the question for investors becomes, how can you generate income and manage what might be, again, a sort of a middling, still reasonable, but middling risk asset performance over the next couple of quarters. And so that's why, from our perspective, credit is such an interesting opportunity. And where equity is concerned, rate cuts really are still a big part of that story. When some of the structural themes that we've thought are really interesting around the semiconductor supply chain, around energy, those are sectors that tend to do well when rates are moving lower. And so it's really a commingled story between debt and equity.
I mean, there are others, there are plenty of people, by the way, who agree with you. I think Rick Reeder sat in that chair and made the case, look, a lot is in the equity market already. There's a lot of good news priced in. Valuations are rich. They may not be too rich, but they're rich nonetheless. Thus, the better risk reward right now is in credit. I know he's a credit guy, or certainly he's the CIO of fixed income at BlackRock, the world's largest asset manager, but he is head of the global asset allocation team too. So he thinks about stocks. But the point is the same, that a lot's in the stock market and the better risk rewards in credit. And you agree?
I do agree. Now, for investors that are looking for equity market ideas, there's a couple of areas where I think are really interesting to play. I just mentioned that some of the secular themes around semiconductors, around energy, those are the sectors that tend to benefit as well from the cyclical reality that's cutting rates. So those are high conviction opportunities from my perspective. They also are likely to be relatively supported regardless of what happens in November. And I see a lot of investors waiting until November to make big allocation moves.
You feel like this market's kind of been a little choppy. It hasn't been a tremendous amount of activity. Do you think this is a precursor for what we should expect now up until for the next 30 plus days, almost 40 days?
Yeah, I think that's the case. Now, when it comes to what difference will the election make, a couple of things. First, I think if we have a sweep in either direction, that's a +1 for growth, inflation, and potentially for rates. So I do expect that the market is going to have to adjust over time this rate cutting expectation down a little bit, meaning the Fed will have to cut a little less than the market thinks. That would be accelerated by a sweep scenario. Other themes that we're looking at, the president. Whoever's in charge has the right to levy tariffs, regardless of who's in Congress. And so that's another potential inflationary risk. We're looking at that. But sectors are something that we actually think some of the old sector norms around Republicans versus Democrats not likely to apply this time around. Both candidates have moved differently from the past as much as they're different from each other.